The most important source of revenue of the government is taxes. The act of levying taxes is called taxation. A tax is compulsory charge or fees imposed by the government on individuals or corporations. The persons who are taxed have to pay the tax irrespective of any corresponding return from the goods and services by the government. The taxes may be imposed on income and wealth of persons or corporations, and the rate may vary. Hello, friends, welcome back to the channel. Like, share, subscribe, and don't forget to press the bell icon. Compulsory monetary contribution to a state revenues assessed and imposed by a government on the activities, enjoyment, expenditure, income, occupation, privilege, property of individuals and organizations. Tax is imposed imposition of financial charge or other levy upon a taxpayer by a state or other the functional equivalent of the state. British rule in India became established during the 19th century. After the mutiny of 1857, the British government faced an acute financial crisis. To fill the treasury, the first Income Tax Act was introduced in February 1860 by Sir James Wilson, British India's first finance minister. The act received the assent of the Viceroy on 24 July 1860 and came into effect immediately. It was divided into 21 parts with 259 sections. Income was classified in four schedules: income from landed property, income from professionals and trade, income from securities, annuities, and dividends, and income from salaries and pensions. Agricultural income was taxable. The 1922 Act was amended 29 times between 1939 and 1956. A tax on capital gains was imposed in 1946, and the concept of capital gains has been amended a number of times. In 1956, Nicholas Caldor was appointed to investigate the Indian tax system in light of the second 5-year plan's revenue requirement. He submitted an extensive report for a coordinated tax system, and several taxation acts were enacted. The Wealth Tax Act 1957, the Expenditure Tax Act 1957, and the Gift Tax Act 1958. The Direct Taxes Administration Inquiry Committee, under the chairmanship of Mahabir Tyagi, submitted its report on 30th November 1959, and its recommendations took shape in the Income Tax Act 1961. The act, which became effective on 1st April 1962, replaced the Income Tax Act 1922. Current income tax law is governed by the 1961 Act, which has 298 sections and 14 schedules. The Income Tax Act 1961 has been brought into force with 1st April 1962. It applies to the whole of India and Sikkim, including Jammu and Kashmir. Since 1962, several amendments of far-reaching nature have been made in the Income Tax Act by the Union Budget every year. The Indian Income Tax Act formed the basis of taxation laws in India. However, it was revised and replaced over the course of decades. The law was revised in 1886 to improvise on some categories for which tax can be levied. The new categories included net salaries and profits from businesses. The next revisions came in 1918 and 1922. The Act of 1918 repealed the 1886 Act and formed many new important changes. There are two types of taxes in India. First one, direct taxes. Second one, indirect taxes. A direct tax is really a tax which is paid by a person on whom it is legally imposed, and the burden of which cannot be shifted to any other person is called a direct tax. For example, income tax, wealth tax, gift tax. Now, briefing about what is income tax. Income tax is a tax on income. Income tax is a central subject according to the Constitution of India. Income tax is a very important direct tax. It is an important and most significant source of revenue of the government. The government needs money to maintain law and order in the country, safeguard the security of the country from foreign powers, and promote the welfare of the people. It is the foremost duty of the government to bring out such welfare and development programs which will bridge the gap between the rich and the poor. For this purpose, mobilizations of funds from various sources is required. These sources may be direct or indirect. Income tax is one of the most important tools to achieve balanced socio-economic growth. Moving on towards the objectives of income tax. The objectives of income tax may be to reduce inequalities in the distribution of income and wealth, to bring out equity between classes of taxpayers, to accelerate the economic growth and development of the country, to make available of funds for economic development, to encourage investment in new capital goods, to channelize investment into those sectors which contribute the most economic growth. Every person whose taxable income for the previous financial year exceeds the minimum taxable limit is liable to pay income tax to the central government during the current financial year on the income of the previous financial year at the rates in force during the current financial years. Now, the features of income tax. The income tax is charged on the income of previous year at a rate which is prescribed by the Finance Act for the relevant assessment year. The Finance Act is passed every year by the Parliament in the form of budget. Income tax is levied on a person in relation to his income of the previous year. The taxpayer's liability is determined with reference to his residential status in the previous year or accounting year. Liability to income tax arises. Liability to income tax arises only where the total income in the accounting year exceeds the maximum tax free amount prescribed by the Finance Act to that prevalent years. The rates of income tax are progressive and incidence of tax increased with the rise of income. It is compulsory to deduct the tax at source and to pay it to the government. Now, moving towards wealth tax. The Wealth Tax Act 1957 was an act of the Parliament of India that provides for the levying of wealth tax on an individual, Hindu undivided family or company. The wealth tax was levied on the net wealth owned by a person on a valuation date of 31st March of every year. The act applies to the whole of India. The application of the act has been discontinued since 1st April 2016. The wealth tax was abolished in the Union Budget 2016 to 2017 presented by Union Finance Minister Arun Jaitley on 28 February 2016. The wealth tax was replaced with an additional surcharge of 2% on the super rich with a taxable income of over 1 crore annually. Gift tax in India was introduced in the year 1958 and was abolished in 1998. The government reintroduced it in the year 2004 under the head Income from Other Sources. Receiving or sending gifts can be a part of money laundering or tax evasion. So the tax officer keep an eye on such transactions through the details filed under the income from other sources head. Taxation rules on gifts exchange have been laid down under section 56 to 6 of the Income Tax Act. It states that any gift received with or without consideration in excess of rupees 50,000 in a financial year will be added to the income from other sources and taxed according to the slab. Any individual receiving cash gifts exceeding rupees 50,000 in a single financial year will have to add this income to the gross total income and pay tax accordingly. If the gift is received by an individual without any consideration and the fair market value of such gift is more than 50% or 50,000, then the aggregate value will be taxable in the hand of such individual. If the gift is received with consideration but for a value which is less than the fair market value and the difference exceeds rupees 50,000, the difference in the FMB and the consideration will be added to the income and taxed accordingly. Indirect taxes are the levy of tax is made on one person and the responsibility of paying the tax to the government is fixed on some other person. For example, excise duty, custom duty, sales tax and value added tax VAT. Now moving towards excise duty. Fundamentally, excise duty is the tax levied on domestically produced goods. Generally, it is charged on their production and sales and is also known as CEN VAT or Central Value Added Tax. Central excise duty is an indirect form of taxation and is collected from a customer by a retailer or an intermediary. It is paid when goods are transferred from the production unit to a warehouse. This particular tax is governed by two sets of Act: Central Excise Act 1944 and Central Excise Tariff Act 1985. Ideally, the Central Board of Excise and Customs is responsible for the collection of excise duty. With the introduction of GST, Good and Service Tax, several indirect taxes has been subsumed, including excise tax. Nonetheless, it is still applicable to a few items like petroleum, liquor. A sale tax is a consumption tax imposed by the government on the sale of goods and services. A conventional sales taxes is levied at the point of sale, collected by the retailer and passed on to the government. A value added tax, VAT, or a good and service tax, GST, general consumption tax, GCT, is a consumption tax that is levied on the value added at each stage of a product's production and distribution. Value added tax is similar to and is often compared with a sales tax. Value added tax, VAT, is an indirect tax because the consumer who ultimately bears the burden of the tax is not the entity that pays it. Specific goods and services are typically exempted in various jurisdictions. Customs duty refer to the tax imposed on the goods when they are transported across the international borders. The objective behind levying customs duty is to safeguard each nation's economy, jobs, environment, residents by regulating the movement of goods, specially prohibited and restrictive goods in and out of any country. Every goods has a predefined rate of duty that is determined based on various factors, including where such goods was acquired, where such goods were made, and where these goods is made of. Also, anything that brings into India from the first time should be declared as per the customs rule. For instance, need to declare the items purchased in a foreign country and any gift which acquires outside India. Now talking about good and service tax, GST. The goods and service tax, GST, is a successor to value added tax, VAT, used in India on the supply of goods and service. Both VAT and GST have the same taxation slab. It is a comprehensive, multi stage, destination based tax. Comprehensive because it has subsumed almost all the indirect taxes except a few state taxes. Multi staged as it is, the GST is imposed at every step in the production process but is meant to be refunded to all parties in a various stages of production other than the final consumer and as a destination based tax. It is collected from point of consumption and not to point of origin like previous taxes. Good and service are divided into 5 different tax slabs for collection of tax: 0%, 5%, 12%, 18%, and 28%. However, petroleum products, alcoholic beverages, and electricity are not taxed under GST and instead are taxed separately by the individual state governments as per the previous tax system. The tax came into effect from 1st July 2017 through the implementation of the 105 Amendment to the Constitution of India by the Government of India. 1st July is celebrated as GST Day. The GST replaced existing multiple taxes levied by the central and the state government. Tax deduction at source TDS. The tax deduction at source means that the person responsible for making payment of certain incomes to the income earners deduct income tax at the prescribed rate on such incomes before payment is made to them. The amount so deducted at source shall be deposited by the deductor in the government treasury within the prescribed time limit. The tax so deducted is called deduction of tax at source. TDS should be deposited to government on or before 7 days from the end of the month in which the deduction is made. Tax collected at source TCS. Tax collected at source TCS is the tax payable by the seller which he collects from the buyer at the time of sale. The Income Tax Act governs the goods on which the seller has to collect tax from the purchasers. The sales deposits the TCS amounts within 7 days from the last day of the month in which the tax was collected. Procedure for passing the money bill. A money bill can be introduced or originated only in Lok Sabha. A money bill can be introduced only on prior recommendation of the President. Lok Sabha Speaker will decide whether it is a money bill or not. His decision is final. No one is challenging his decision. A money bill can be a government bill only. Once a money bill is passed in Lok Sabha, it is transmitted to Rajya Sabha for its consideration. Rajya Sabha can neither reject nor amend the money bill. It can make only recommendation and has to return the bill within or without recommendation to Lok Sabha in 14 days. The Lok Sabha may or may not accept the recommendation of Rajya Sabha. Thus, return bill is considered passed in both houses. If Rajya Sabha does not even return the bill in 14 days, it is considered passed in both houses. The bill has to be passed by the Parliament within 75 days of its introduction. Financial bill means a bill ordinarily introduced every year to give effect to the financial proposal of the Government of India for the next following financial year and includes a bill to give effect to supplementary financial proposal for any period. A financial bill is a money bill as defined in Article 1110 of the Constitution. The proposal of the government for levy of new taxes, modification of the existing tax structure, or continuance of the existing tax structure beyond the period approved by the Parliament are submitted to Parliament through this bill. The finance bill can be introduced only in Lok Sabha. Rajya Sabha can recommend amendments in the bill. The bill has to be passed by the Parliament within 75 days of its introduction.